What's up, guys? Welcome back to the channel. How you doing? It's the weekend. Saw a lot of stuff this week. Stock market's not melting down, but it's getting like, you're starting to see like 2% drops a day, 3% drops a day. Every YouTuber out there going like right now, like, bro, the recession's, it's coming, man. It's yield curves are inverting, and there's like yield curve inverting is almost like a guarantee you're going into a recession. Which is like it's like when these two lines or two interest rates cross. I think it's the 2-year and the 10-year. Could be wrong. Could be the 10 and the 30. Either way, yield curves inverting is a bad sign. Things selling off and bad earnings from like Amazon or Apple is a bad sign, etc. But when everyone's saying it, including like the big banks, it just makes me think like, nah. I think it's just a pullback, man. So I have to take the opposite side. Now, do I think that at some point there's gonna be like a meltdown in the debt market and like things are gonna get gnarly and like Americans will revisit 1929 and then their government will get crazy and steal things from them like they did in 1933? Yeah. Oh yeah. Definitely. But like, is it happening like right now, like beginning of the summertime in like 2022? I mean, I don't know. I mean, it kind of feels like you'll see this little bit of pullback, right? Everyone's like, oh, the inflation's really high. It's going to cause a recession. And it's like, yeah, but when the currency's devaluing at the rate that the US dollar is devaluing, but it's also still the cleanest shirt in the laundry bin. And so people in other countries are rushing into the dollar, which is causing the dollar to go up. Like you're seeing it on the Dixie, the DXY. It's relative index to other currencies. Dollar is rising. People want to get their capital into America. I think it's a pullback. I have to put this out there. Mises wrote about a crack-up boom, and this is a guy that was around in the 20s and the 30s, and he saw what happened in Weimar Germany and the whole thing. And he, in 1921, like news articles, you go back to like old newspaper stories and stuff, they're all like, yo, Germany's the place to be, man. 1922, the German stock market outperforms the American stock market. 1923, 24, 25, bad times, hyperinflation, like not good. So when you look at the money supply as far as US dollar, starting from like 2020 to where we are now, it's identical to the Weimar Germany chart. It's really eerie. If any of you guys have like a really good chart on this, mine are like, they're hard to see and put them on, they're not good. But like, you got some like good data on this. They're really eerie when you look at them, and you never really trust any of the data these days that are compiled, but you're like, this is really weird. You got like Michael Burry, famous guy from The Big Short, and he's like, yo, I'm telling you, it's a hyperinflation, man. Well, in that case, what occurs is people try to rush to get out of the dollar, and what they do is they buy assets. They're just like, well, like for the last 10 years, for example, the saying has been Apple stock is as good as cash. It's better than cash. Instead of having your cash sitting in a bank, earning no interest, you would just put it in Apple stock, and as the market cap of Apple continued to rise, it was a safe play. And now we're starting to see that possibly reverse. But I just think like you don't have the biggest bull run in history, like 40-year equity bull run, like so substantial that like probably 20 years from now, like Buffett and all those guys are gone, people will probably like, yeah, he's a great investor, but he was also a great investor during the largest bull run in human history. So, it helps. It makes you look good. But I just wonder about that, because I'm like, Mises was really clear on this crack-up boom. You can read about it in Human Action and some of his other works. I'm actually rereading it right now, which is like, Mises is just, he's a brilliant mind, absolutely freaking brilliant mind. And I'm like, yeah, I see everyone talking about a recession. Yeah, I don't know, man. I got to take the crack-up boom side of it, because personally, and I could just be like living in this little bubble, but like personally, I know people in my own life that have major purchases going on right now, like major. Like one buddy just bought like a 50-foot boat, and he's like bringing it down the Carolina coast right now. Like another dude's like, hey Trav, should I cash out the equity in my house and like throw it in the market? And I'm like, no, dude, no, not really, bro. Like, he's like, well, what do you think, man? Should I buy? And so I'm just like, okay, cool. I have other buddies that have already done that, so I'm like, people are starting to access like this pool of liquidity they might have access to before interest rates go up. And it's like, yeah, that's really reminiscent of crack up boom. If you think about it, right? If you're like, okay, we're going up the stairs, right? We're going up the ladder. Like before you really launch, you would go down a little bit and then you'd launch, right? And so I think, and we'll see, we'll know in 6 weeks if I'm right or if I'm completely wrong. But I think what we're gonna see is a little pullback action here in May. And then then it's just gonna rip. Like I think like by the time you get to mid-June, like we'll know by June 20th, this is either happening or not. Like, yeah, you're going into a recession or you are in a crack up boom. If you're in a crack up boom, like historically, expect a like 40% rise in asset prices. Call it like the S&P, the Dow, whatever you want. Like, expect a 40% like rip to the upside before like an 80% drop off. So I think that yes, an 80% drop off at some point in time, it just feels like, yeah, there's this 90-year, 100-year, like what they call a centennial, crash. And it's pretty obvious. Like, you can look at like the 30s and be like, okay, yeah, you can even like, there's even like a 50-year cycle that makes a lot of case for, like, in 1980s, 1981, the gold to Dow ratio was 1 to 1. 1933, it was 1 to 1. 1861, it was 1 to 1. And then it gets like really far, like really spread out like it is now. Like 1 ounce of gold is roughly $2,000. A share of the entire Dow, call it like 33 grand or so. So it's like 15, 16, 17 ounces. But back in 1980, it would have been 1 to 1. It typically goes to about, and then I believe in trends reversing and cycles occurring. And so it's like, at some point in time, do I think an ounce of gold equals a Dow? Yeah, definitely. But that's also the time to roll out of the gold or whatnot, if that's like your safe play, and roll into the Dow. Because if you own the Dow today, you're making $830 a year in passive income, and you've been doing that for a hot minute. So you've done really well by just playing it super safe since the 80s. And that's all you got to do. Like, you like at these times, like, you're like, hey, what are the safe plays? Like, gold, silver is why I sell it. I'd love to help you out. My email's below. But it's like, gold, silver is pretty safe play. Gold, silver equity miners are maybe an even more leveraged play, a little bit riskier. You don't necessarily own those accounts, right? They could get shut down on you. It's harder to be like, no, I know where the silver's buried. I know where the gold is, right? But it's harder. Like, I like crypto. I'm a fan of it. But like, is it all going to crash like real soon? I just don't think so, man. Like you're living in a spot where they're telling you the inflation is 8.5%, but the interest rates are like 2, like less than 2. Like, last time the inflation rate was recorded at 8.5%, they measured it differently. So it actually would be around 16 or 17%. This would have been in the 80s, Paul Volcker days, early 80s. But when the inflation rate was officially 8.5, which I'm just saying they measured it differently, but when they said it was 8.5, the interest rates were well above 12. Actually, I believe they're above 17. I think they're around 18 or so, which is really, really extreme. I mean, that's an extreme example. Typically, if you take like a finance class at an undergraduate university or something like that, what they will tell you, these Keynesian economists and professors will tell you is like, hey, if the interest rate, the inflation rate in the economy is around 3%, if you want to reduce it, you need to have about 5% interest rates. And so the theory there is that your interest rates would be two percentage points, or what they're called 200 basis points ahead of your quote inflation rate. Now, all these numbers are fake, funny, all the whole thing. But the idea that we're going to see things stop inflating, I just don't think so. I mean, I could be totally wrong, right? If economic activity slows and then everything's like Shanghai shutting down, like Russia doing their thing, our elites just doing complete insanity, egging this on. It's almost like there's this global conspiracy, right? But it's almost like they're all like on the same page. It's like, let's crush the populace. Like, let's do that. But like, do I think that this is it? Like, this is the end of the 40-year bull run, and it's just going to be like, oh yeah, things have been slow for like 90 days, and now that's just it. Game over. I don't know. Because it feels like if you have a 40-year bull run, you have an epic blow off top. Like, you don't just have like things have been slow for 30 or 60 or 70 or 90 days. No, we're going to have a recession. Assets are going to... No, I just don't think so. I just don't think that you go from like the largest bull run in history to just like a sell off. I think you go from like the largest bull run in history to like a pullback, a rip to the upside, and a glorious, epic, like biblical, historical, something for the history books for 1,000 years from now, crash and a collapse of your global trade, economy, supply chains, everything. So what I'm saying is, like, I just think that there's more upside, man. So I gotta take that, especially because nobody seems to agree. So it's like, when nobody seems to agree, I'm just kind of like, man, that's gotta be, maybe it's right. You know what I'm saying? Maybe it's right. But anyway, I want to know from you guys. What do you guys think? Because we're going to know in 6 weeks. This is going to be like, this video will be up like the 1st of May here, right around there, maybe early, like last couple days of April here. But it's like, I think that things will probably rip to the upside. Let me know in the comments what you guys think. I'll see